Hey everyone, happy Thursday, January 9th. It's about 10 a.m. on the West Coast, and it's time for another market update. This week is jobs week, so we got a lot of important data that we know the Fed is paying very close attention to. Besides inflation, the labor market is their focus. And then after that, I want to get into an important topic that I hear from a lot of my borrowers, and I know that a lot of realtors hear from their clients is that they are waiting for rates to drop. Everybody would love mortgage rates to come down, but there are some things to think about if you do that, some risks and some costs. So first, let's get to the data because, like I said, it is jobs week, and jobs week is very important. So far this week, we've gotten the November JOLTS and the December ADP report. The November JOLTS, that's job openings. One thing to keep in mind. These numbers can be a little inflated just because this day and age, a lot of people post jobs online. The way this report works, if you were posting a job in 50 states, it would pick it up as 50 different job openings. And then also that, a lot of employers, when they're posting jobs on these different job sites now, are posting the same jobs multiple times, but using different headlines, different job descriptions to gather more, resumes. So again, numbers can be a little inflated, but something that the markets pay attention to. And those jumped. They were supposed to come in at about 7.7 million and came in just below 8.1 million. And then they also adjusted the previous month, October, up about by 65,000. So that number actually is the highest since May of last year. So that's the headline number. That's the thing the markets did not like at all. But if they took the time to look a little deeper, there was some positive, not necessarily positive, but good things for mortgage rates in there. One would be the quits rate decreased from 2.1% to 1.9%. That's the lowest since 2014, if you take COVID out. And what the quits rate is people quitting their job to take another job. So the less people are quitting, the less confident they are they can quit and find another job. So that doesn't scream a lot of strength. The other thing that was kind of good for us is the hiring rate dropped from 3.4 to 3.3%. That is the lowest since 2013 without COVID. So again, companies feeling, not hiring as much, that's a sign of, some labor market slowdown. But like I said, that headline number coming in higher than expected and making adjustments up and all that, that is what the market driver was. And then December ADP came out yesterday. That was expected to be about 140,000 jobs. It came in at 122,000 jobs. So a little bit of a miss there, which is good for mortgage rates. One thing, the annual pay increase for job stayers dropped from 4.8 to 4.6. That's the lowest since, let's see here, that is the lowest since July of 2021. So that's again a sign that maybe some wage inflation is coming down. Another thing to look at here, right? 97,000 of the 122 for large businesses, 500 plus employees. So small business, medium business, not doing much hiring at all. So like I said, those are the ones we've got so far. And then tomorrow we get the December BLS jobs report. That's the big one. That's the one that we're all waiting for. That will be, the market driver. Who knows? That comes in high, comes in low. It's been all over the place, mainly coming in higher than we'd like and then adjusted down later. So that's a big one to watch right now. I think they're expecting about 160,000 jobs created and the unemployment rate to stay at 4.2%. Next thing, Fed minutes. So the Fed minutes from their last meeting, December 18th, they released the minutes from the meeting, so what they talked about. There was a lot of talk. There's definitely some more inflation concerns, and a lot of that has to do with the incoming administration and tariffs and things like that. Some of the members indicated they're building some cushion into their numbers, thinking inflation won't come down as fast because of the tariffs. So it'll be interesting to see, how that transpires. But definitely the message, if you read the minutes, not a very, very good chance that the Fed will cut rates at their next meeting at the end of January, January 29th. So it means they'll pause. They'll just stay where they're at, which is not what we want. So that I think right now is 93% chance they'll stay where they're at, 7% chance they cut. So that BLS jobs report, if that comes in, worse than expected for the country, better for us, it would have to be really good for us if the Fed is going to cut rates. So probably something like, the unemployment rate jumping, from 4.2 to 4.4 or something like that. Next thing, initial jobless claims, again, very low. Estimate 213 came in at 201,000 new unemployment claims. This is continues to be a really low number. Again, shows the job market at least is seemingly strong. So where does that leave us? Besides that, there was some manufacturing data that came in a little stronger. The average conventional rate, according to a lender survey, came in at 7.15, up from 7.07 last week. So above 7, creeping up above 7. So we will see where that goes. But right now, we definitely need some of that data to come in our favor because if the data keeps showing strength in the economy and the Fed doesn't cut, we could probably see this number go higher. So the main thing I want to talk about, like I said, the cost of waiting for rates to drop. So, like I said, you run into a lot of people say they will waiting for rates to come down, whether they're looking to buy or sell. A lot of people don't want to give up their current rate that they have on their home. The saying you'll hear out there is marry the home and date the rate. So, you want to marry the home long term, but just think about, you're dating the rate, you're getting it short term, and then plan on refining in the future. One thing I would say is that if you plan to go that route, you have to be okay with basically marrying the rates. Because if rates don't come down, if they jump for whatever reason, World War III breaks out or whatever, you got to be okay with where you're at. You can't just assume good things are going to happen, because that's how you can end up in some trouble. So, getting into it, according to NAR, one for every 1% that mortgage rates drop, 5 million more eligible borrowers jump into the market. So that's more competition. So just as far as technical stuff, that's one reason you wouldn't wait for rates to come down, because you're going to have more competition when you go to buy a house, or whatever it may be. Good for sellers, not good for buyers. So in that situation, a higher rate is a buyer's best friend. Right now, with higher rates, you're going to be able to, maybe ask for seller credit. You don't have as much competition. You can take your time searching for a house, things like that. So, we don't like the higher rate, but it can be helpful when you're trying to get a house. Whereas wait for rates to come down, that becomes a very, very competitive market. It's harder for people, 5% down to win out on a home where other people are offering 20, 30, 40, 50% down. Tight inventory becomes tighter. So we're already tighter. At least the less choices. So if there's if there's not a lot, if everything out there is just going quick, 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 and we fall back to where we were previously, where there's not a lot of availability because it's all getting bought up. Again, that's less choices for the buyer. It's a little bit more difficult to buy. And then upwards pricing pressure. More sales, obviously, sellers are going to start raising their prices. The lower rates go, the higher basically home prices probably will go as well. So those are all narrative things to keep in mind. On the technical side, just as far as payments, I'm blocking it here, but this is waiting 1 year. So let's just take an example of a $700,000 house where you're putting 20% down, which is very common to avoid mortgage insurance. So your loan would be $560,000, and let's just say today's rate would be 6.875, a little lower. This is a little dated by about a week, and rates have come down. But let's say they bought it down a little bit. Let's say you're getting a 6.875. Your P&I is going to be $5,075 a month. Pretty big payment. If you waited a year, your property value, that same house is appreciation, the average about 4.1%. So let's say that house went up to 728, 700. Your loan amount to get to that same 20% is going to go up to 562 or 582, 960. But let's say rates did come down and we came down to 5.875. So nice drop. I would love to see that. Your payment will come down, obviously. So your payment will definitely be lower by about $182. So, the cost of dating the rate would be a monthly cost by, taking that short-term rate, the lower or the higher rates, would be $182. The yearly cost for that higher rate would be a little under 2184. And then, the whole point of this, of dating the rate, is at the end is to, a year later to refi once rates come down. So let's say you're doing a refi and the cost is for this one, let's say a half a point, 3,500. So depending on the company, it's going to be a little different for each borrower, things like that. So those are your costs. So, add those up, 2184 and 3,500. So the cost to date the rate for a year, your monthly payments plus then going to refi, let's say is 5,684, a little under $6,000. So a chunk of money. But keep in mind appreciation gain, that, if you own the home a year earlier, you're the one that got that higher home value. Your price went up by 28,700. So you take out these two different numbers from the 28,700, the benefit of buying now at the higher rate, if you can afford it, is in this example is a little over $23,000. So that is something to keep in mind. We all want lower rates, but in that situation, if you can afford the rate where it is, if it's not going to put too much stress on your family, you qualify, all that kind of stuff, usually the best time to buy is now. You're going to take advantage of that appreciation. You're going to miss, that huge demand when the rush happens, when rates do come down. So that's just something I want to go over. It's something that, obviously a lot of people, are looking for rates to come down. So if you have any questions about that or anything at all, please don't hesitate to reach out, and I'd be more than happy to help. Thanks a lot, guys.